What if I told you that wealthy people make money when they buy cars instead of pay money for those cars by using just this one simple trick? All right, in this video, I'm going to show you how you can buy a car with a concept called infinite banking, where you can essentially become your own bank. So this is even better than The Price is Right. It's not like you win a new car. No, this is where you can finance a new car forever, okay? So I'm gonna give you 3 reasons why you may not wanna do this. So I'm gonna teach you how to do it, but I'm also gonna give you 3 reasons why not to do this. So be sure to hang on till the end to learn what those are. All right, number 1, let's talk about arbitrage, okay? Arbitrage is how a bank takes your money out of savings and then turns around and loans it back to you at a higher interest rate, right? That's arbitrage. It's taking money and then taking and making more money off of that money. So when a bank, say they borrow from you at 1% because they pay you 1% on that nice, wealthy piece of crap CD we talked about, right? Or savings account, they're paying you 1%, but then they turn around and loan it to you at 5%, they're making not just a 4% return, right? They're actually making about a 400% return because they're paying $100 to then make 500. So they actually quintuple their money by making more money off of it. That's what arbitrage is, that they're borrowing the money from you out of savings, right? Banks, believe it or not, love debt. They have more of it than anybody. And they'll borrow it to be able to use from you out of your savings account to then turn around and loan it back out to everybody else to make a lot more money. That's what arbitrage is. And so the question you have to ask yourself is, can I make arbitrage, right? Well, you can get arbitrage, right? For example, you can get a line of credit against your whole life insurance policy and make more money than you pay the bank. Now, what I mean by that is that, when you buy a whole life insurance policy, whole life insurance is different than term insurance. Term insurance is really just death insurance, right? You have to die for somebody else to get paid. It's the least sexy and the simplest version of life insurance. It's like auto insurance. You only get paid when you have to use it. Sadly, with life insurance, when it's term life, it's really just death insurance, isn't it? But with whole life insurance, they also have this tax-free savings account component that goes with it. So yes, you have this death benefit, but you're able to grow this money tax-free inside there, kind of like a Roth IRA, but you don't have all the stupid rules and limitations and everything else that you get. So what have people done? In fact, even banks have done this very thing. They've actually gone and they will borrow money against that life insurance because they know they can get a line of credit from some other bank or some other institution to leverage the money that's sitting inside that policy. I don't mean the death benefit. I mean the cash savings account that's in there. So they're getting a line of credit against it, right? Just like someone's getting a line of credit off their house to get equity, they're getting a line of credit off of the cash. You could do the same thing with the bank. You have a savings account, you can get a bank line of credit against your savings account from the bank. Thing is, they will charge you more money than what they pay you on that savings account, but not true with life insurance. With life insurance, you can get a lower interest rate on the loan than what they're paying you. So in many cases, most insurance companies right now, at least the good ones, are paying you at least 5 to 6% tax-free on your money. Now, what if you got a line of credit at 4%? So do the math. You earn 6%, you borrow from the bank at 4%, that means you're making 2%. And we all know, just like I described, that's really more than 2%, because if that were 10,000 bucks, you might pay 400 bucks for that year, but you earned $600. You made 200 bucks off of the bank's money. So what does that have to do with cars, right? Well, with the cars, this means you can say, rather than me paying cash outright, well, a lot of people want to insist on buying cash for cars. Got to pay cash. Remember this, you're always paying interest on your money, always. Even if you pay cash for something, you've now lost the ability to earn any interest on money. That's called an opportunity cost. You've lost the opportunity to make money on that money. Now, you don't pay any interest, but you also don't make any money. The question is where could you make the better interest? Can you make more than what you paid the bank? So same thing here. With the life insurance policy, you have the cash in there, but rather than touching your cash, you just get a line of credit either from the insurance company or a bank. You get a line of credit where they lend you the money because the money's already in here. This money is here securing it. They know it's the cheapest, easiest money for because it's there. It's there, it's guaranteed, it never goes down, it never loses money. They know they can always get to it if they need it. So they give you this loan. You take that money, say like at 4%, buy the car, and like I said, you're making like 5 or 6% while paying 4%, and voila, guess what? You've just made money on that money. So you've made 1 or 2% plus, you have a car that you're not paying interest on, right? So you're able to make money off of the money you borrowed from the bank. Now, here's the thing. Why wouldn't you get that? I mean, that sounds brainless, right? I mean, it's essentially getting a loan that pays you versus you always paying for the loan. It's even better than just using cash where you make nothing. You pay nothing, you make nothing. Here, at least you make money. Well, there might be a reason not to use it. And this is what I teach a lot of our clients, is that we don't want to use our life insurance to buy a car. Why? Because I can get a bank loan if it's still cheap money at 3 or 4%. Why would I want to have to pay 4% on my own money? I'm going to go for the cheap money with the bank and let the money that's in my life insurance, I go and use that to invest. I go use that to make money elsewhere. So when I go buy a car, even though I can buy them all in cash outright, I don't. I go and I leverage my banks. And the thing is, even if I have a lot of cash sitting around, they're like, oh, this is awesome. Please take our money. Here you go. Sorry, that's my fake money. That shows you how much bills I carry around. I carry no bills, right? I just use cards, like maybe you do too. So I can just use that money however I want. So I borrow from the bank at, like I said, 3 or 4%. I just pay them. I don't even use my life insurance. I let that money grow elsewhere. So, the real question you have to ask yourself is, could I get a lower interest on the car loan? Could I get a good return? It just depends. If rates go up super, super duper fast, maybe your life insurance would be the best place to go, but maybe it's not. Here's the other thing too, is that you may not want to also slow down the growth of your policy. Some policies, when you borrow from them, do pay less. So not only do you avoid being able to make interest on that money or making a lot more interest on that money, but also you might slow down the amount of interest you make. So like I said, it might be better just to invest in money in other places. So what I do is I love getting loans for my cars. And I talk about bank loans, not my whole life insurance loans. I get bank loans for my cars. I get bank loans for my mortgages, because again, it's still cheap money. The thing I won't get bank loans for is usually a credit card, right? Credit cards, that's higher interest. We don't use that. But for car loans, for mortgages, sometimes even for student loans, sometimes those are actually worth paying the interest to those so that my money can go and make more elsewhere. So where is that? All the time when we talk about using our money from our life insurance, we want to double dip on our interest. We want to make money in 2 places at the same time. I still can get a line of credit and make money there, but I can go invest it. So like, for example, I just had somebody recently that said, hey, I have an opportunity. I can go into this apartment investment and they will pay me, even on the low end, 10%, but it's probably going to make somewhere between 15 and 20% a year. I said, great. What are you going to use to invest that? They said, well, I'm thinking about finally using my life insurance. I've got this money here. Should I get a line of credit against my life insurance? And I said, why not? Let's try it. So they did. They're making about 2% more on their life insurance, and they're still making the 15 to 20% on their investment too. So many people, they tell you about life insurance like, oh, you can't use that money. That's for down the road. If you do it right and you don't listen to I would say 99.9% of insurance agents out there who don't get how to invest their money, they're just insurance salesmen and they're too small, too old, stale, crappy little suits that they wear. You don't want to use that. You don't want to take that advice. You do something that actually can create real passive income now and make some awesome returns. I'll give you another example. I had another client who actually was wondering if he should cancel his policy. He's like, I'm not doing anything with this because this insurance agent sold me this crappy policy and it's got $300,000 in it. Maybe I should just cancel it because I want to buy an office building. He's like, a building that he was going to put his business in and then rent out the other units. And I said, hold on there, Sparky. His name is not Sparky, just so you know. That's what I call him on this video, not to his face because he might slap me. But I said, hold on there, Sparky, in my mind. Like, before you just go do that, why don't we actually instead get a bank loan against it? Now, instead of using the insurance company, which you can easily do to get the loan, you don't have to apply. By the way, it doesn't even show up on your credit report. That's another cool thing. It doesn't show up on your credit report, and you don't even have to make monthly payments on these loans, by the way. Your due date for paying off these loans is your death, which your death benefit just pays off anyways. So for him, I said, let's get an actual bank line of credit with your local credit union. And they were willing to do it. They said, hey, we'll give you not just $300,000, but they gave him $375,000 so he could build out, make some repairs to the building and have more units to rent. And guess what happened? He was able to use that money. He got a really low interest rate. He paying like $1,800 a month on the building, which for him was cheaper than the rent he was paying for the building he didn't own. So he saved money on his rent for his business. He now owned a building. Now he's renting it out to everybody else. And then what happens a year and a half later? He goes back to the bank. He says, hey, Now I've got this unit, it's renting out, it's all built out. Can I take that line of credit off of my $300,000 so my life insurance now is free to use somewhere else? And the bank said, yeah, put the building as collateral instead of your life insurance. And voila, they kept the same terms, the same better interest rate than he would have got anyways just buying the building by itself. So he got way better deal just by using his life insurance than then a year and a half later had it taken off, and now he can go invest with it again. So many cool things you can do with that. So many ways you can use it. So the question is, do you really want to buy a car? And do you want to finance it, and how do you finance it? Well, first off, I don't recommend buying in cash. I like bank loans. If you can get bank loans and then turn around and make more money with it, great. And one of the best ways to be able to pay for that car, you could use your infinite banking policy, but you know what? You might just use the bank and then use your infinite banking policy, despite some of those infinite bankers try to sell you on this crap anyways, is use that money to go invest in better investments that will make you much more money than you would just using your car to buy with your life insurance. That's the key. So if you want to make more money, that's the key thing that you've got to remember in your head is, how would a wealthy person do it? The wealthy person always goes for what pays them the most. I would love to hear if you guys have done this strategy already with infinite banking and using this to buy cars or even just invest. Put that in the comments below. What's been your experience? What's worked? What hasn't? And if you like this video, check out what is the difference between passive and active income now.